here is an example of cash. Here's a cash book to bank, bank to book. We will see a lot of these. So it seems that we are going to be starting with Poland Corporation and a balance of $200,000 in cash on its general ledger on December 31st, year one. Additionally, Poland had a few other items on hand, which we will go through here. And what is the cash balance that we would report on the year-end balance sheet? All right, so essentially, are these items adjusting items? Do they adjust what we should see on our cash balance? Now let's kind of think it through, and starting with our 200,000, do we add, subtract, or ignore this amount? Well, it is a $17,000 check payable to Poland, dated January 2nd, year two, that was not included in the December 31st checkbook. All right, now, should this be included in the balance? I'm going to say no, because it belongs in the year two balance. It was dated January 2nd, year two. There's no reason why it should be year one. Even though we're dealing with accrual basis accounting, the cash balance on the balance sheet, trial balance, should reflect the cash actually on hand, or the cash that you're holding. So that should not be included. We're going to ignore this. Not add it, not subtract it, but ignore it. What about a check payable to Poland that was deposited December 22nd, included in the balance? So it's included in the 200 right here. Definitely keep this in mind when you're reading questions. It can be super tricky if they included it or not included it. Should we subtract it or not? So it was returned non-sufficient funds. Now this is going to be a bounced check. So let's say a customer came in and paid you with a check, and you said, great. Poland said, great, we have another sale. But when they went to cash the check, it didn't work because the person who gave it to you didn't have enough money in their account. That's what happens here with this NSF check. All right, so the check was redeposited in year two and cleared on January 7th. Okay, so if this check went through, we would have included it in the 200 if it went through in year one. But because it only went through in year two, we're trying to accurately represent the balance. We're trying to accurately portray what our balance is. So this should not be included. It was included, which is going to result in a subtraction. So we're going to subtract this 5,250 from 200,000, and I'll have the solution on the next page for you, but I'm just talking this through now, and we will see the actual math in a second. So now we have a $32,000 check that was payable to a supplier, so we're paying it out, and drawn on Poland's account. And it was dated and recorded in year one, December 31st, year one, but not mailed until January 15th, year two. So do we include it in year one, or do we include it in year two? This one was assuming not included in year one, because it would have to say, just like this other one said it was included in the checkbook balance, this doesn't say it was included. So this is actually going to be an add back, because it wasn't removed from our bank until, essentially it wasn't given to anyone else until year two. So this was still in our cash balance as of the end of year one. So we need to include this. It's under the assumption that this was not included unless it says it was. So adding that back, let's take a look at our solution here. Awesome. So the unadjusted balance was 200. We're going to add back that 32,000 because we should include it, right? It wasn't given away until year two. And then this bounce check, we remove it from the year one balance, but it would be accounted for in the year two balance. It's just classification, right? It's timing, trying to make sure that it's recorded in the right period. Adjusted balance is $226,750.